There are only a handful of sessions left until the end of this month. In the upcoming trading week, we will be getting jobs reports as well as several central bank decisions. So joining me now is Tim Anderson of TJM Investments. Tim, great to have you back on the floor.
It's nice to talk to you.
Well, since we last spoke, we've seen the equity levels breach record highs. And even today, we're seeing the Dow up by 100 points. Sure. I do want to mention that we did get the House backing the Republican tax reform by a very, very narrow margin.
Right.
But given that we're at such lofty levels, where do you see risk coming from?
Well, I would say the biggest potential risk the market has is rates going higher faster than what people may anticipate. I think that's what we saw a little bit with the sell-off yesterday. The 10-year got up to 2.45%. Certainly not a high number historically, but it got there a little bit faster, and people thought, well, maybe we're going right to 2.6 or 2.75, and then maybe we'd have a little bit of asset allocation. And all that being said, we're 9 weeks from the end of the year, and it would be very uncharacteristic for the market to take a real hit in the last in the last 2 months of the year. It's just not in investors' interests when they're looking to lock in their performance numbers for the year.
And you mentioned central banks, so I do want to talk about rate differentials. We have the Fed meeting happening next week, and there's been a lot of speculation surrounding the next Fed chair.
Sure.
But given that the Fed Reserve is currently in a blackout period ahead of that meeting, and we did get the ECB announcement today, what do you expect to see globally?
Well, I think that the very low rates in Europe are going to cap, to some extent, the speed at which interest rates in the U.S. go up. So, Draghi is a master communicator. He's tremendous at the presentation. They're going to cut their QE program by 50% going into next year, and everybody took the presentation as being dovish. So, I think that the global considerations are affecting U.S. rates and putting a cap on them.
And last but not least, Tim, before I let you go, I do want to ask about earnings. Now, the equity indices have been swayed by earnings. Yeah. Today, we're seeing the Dow and S&P 500 higher, but sure, the Nasdaq has been hovering near flat, and that is given the biotech sector and earnings from Celgene hitting that sector today. Yeah. But we do have Amazon as well as Alphabet reporting after the closing bell. Have there been any surprises so far?
Well, look, the new age tech stocks are the FANG stocks, the Amazon, the Googles, the Netflixes have had such a strong move this year. They almost need a fresh catalyst to go to another level. And I think maybe some managers have been taking some money out and putting it somewhere else. Biotech's a very volatile sector. It always has been. It trades in very, very high valuation levels. So any little cautious statement there is going to put a cap on those gains. Certainly, we've seen very, very positive earnings from the big international blue chip companies, and the weakness in the dollar has probably helped that a little bit. We had very positive action in UTX, Cat Tractor, Triple M earlier in the week, FedEx a little bit today. So that's what will be interesting going forward is if the dollar really did bottom out in September, how will that impact earnings of the big multinationals going forward?
Okay, Tim, well, thank you so much for joining me today, and thanks for covering so much ground in this interview.
Sure, thank you.